Why is China crashing its own stock market? Despite having the world's second largest economy and millions of customers ready to spend on fashion, electronics, real estate, and cheap stocks, everyone appears to be avoiding Chinese financial markets. The big question is, why? Hey everyone, welcome back to our channel, the place for people looking to become financially smarter every week. Our goal is to explore the future of business and help you become a better investor. If you like our content, please give us a like and make sure to subscribe so you don't miss our new videos. China's stock market, worth $10.5 trillion and is the world's second largest, is attracting worldwide attention for good and bad reasons. Over the last 2 years, the country's economic strength and rising influence have prompted MSCI, FTSE Russell, and other index compilers to boost its weighting in global benchmarks, attracting investors and helping drive domestic stocks to a peak of $11.8 trillion in February. But the two major onshore stock markets have lost more than $1.3 trillion in value since that joyful season. Some analysts have warned that the downturn may have more room to run as values return to pre-cash levels back in 2015. And if the sell-off continues, speculation of a bailout might arise. To understand how things came about, let's look at what happened in the market over the past year. The COVID-19 outbreak, which was initially discovered in late 2019 in Wuhan, Hubei Province, China, forced a citywide lockdown on the eve of the Lunar New Year. Local stocks fell, indicating a full-fledged worldwide market crash in March 2020. On March 23, the Shanghai Composite Index fell to a 13-month low, putting equities on the verge of entering bear market territory. By that time, the CSI 300, which monitors the largest equities in Shanghai and Shenzhen, had fallen by 16%. But it proved to be a game changer as the lockdown ended. China's GDP, which dropped 6.8% in the third quarter, the weakest 3-month period since the Cultural Revolution in 1976, quickly recovered as the central bank pumped money into the sector. The Shanghai Composite finished the year up 14%. The liquidity-driven Chinex index of small-cap and technology companies increased by a whopping 65%. Earlier this year, as bullish sentiment grew stronger, some areas of the market began to show indications of valuation frothiness. While driving values to multi-year highs, money managers continued to pour additional cash into perennial favorites, ranging from conventional liquor distilling firms to unprofitable technology and new energy companies. Let's take Kweichow Moutai as an example. The world's most valuable baijiu distiller recently traded at a value of 60 times estimated earnings, the most since 2007. According to reports, there were roughly 628 stocks among the 4,900-odd mainland-listed businesses with price-to-earnings multiples above 100 times. Another alert was going off 12,000 kilometers away. Under the weight of inflation fears and taper tantrums, U.S. government bonds began to fracture, pushing the benchmark 10-year Treasury yield to a 1-year high around 1.6% in March this year. The twin bogeys triggered a technical drop in liquor and technology stocks, with losses reaching 20%. Of course, let's not forget to mention the Evergrande crisis that's happening right now. 6 months ago, investors were alarmed when the cargo ship Evergrande became stranded in the Suez Canal, blocking global energy markets and international trade. Today, markets are concerned about a possible default by Evergrande, a massively indebted Chinese real estate colossus which some think may spark a worldwide financial crisis. What's going on with China's Evergrande? One thing's for sure, China Evergrande Group is in serious danger. The real estate behemoth, which also involved in electric cars, wealth management, theme parks, and even a soccer team, which has already been unable to meet obligations on some of its nearly $90 billion in debt, as well as another $300 billion in liabilities, forcing it to restructure obligations with its creditors. Because Evergrande is in the country's largest junk bond issuer, this has understandably caused chaos and confusion in China. The Chinese government's decision to limit the amount of debt that businesses could incur triggered this crisis. Evergrande was forced to halt the construction of new apartment buildings and postpone payments to suppliers as a result of this capital constraint. Customers and business partners are dissatisfied with the company. People who have handed over hundreds of thousands of dollars want their homes built. Investors want their money back. And suppliers want to be paid. After all, if they don't get what Evergrande owes them, they won't be able to pay their workers, who would then be unable to fulfill their own financial commitments. Well, this may all sound familiar and terrifying if you lived through the 2007 housing crash. When a hot housing market collapses, it brings down over-leveraged conglomerates that lack the cash to pay their debtors, causing a financial panic to spread. So far, it does not appear that the Chinese government is eager to intervene. Indeed, recent reports indicate that China is prepared to let Evergrande collapse. How is Evergrande crisis affecting global stocks? Evergrande's difficulties have coincided with a drop of investor enthusiasm for stocks. The S&P 500 dropped 5.2% between September 2 and September 20. Economic indicators, on the other hand, have also been going sideways recently. Employers hired just 235,000 people in August, much less than the market forecast. Consumer confidence has fallen to a 6-month low as retail sales have fluctuated. Inflation continues to rise, and the Federal Reserve has indicated that it may shortly start buying fewer bonds. While not as significant as increasing interest rates, this so-called tapering indicates that the Fed is backing away from its emergency strategy of pouring in a lot of easy money to assist the economy recover from the COVID-19 debacle. Then there's Washington, D.C. In addition to debating the contentious $3.5 trillion social program package and the $1 trillion infrastructure plan, Congress will soon need to increase the debt ceiling to avoid the U.S. Treasury defaulting on its obligations. Republicans are refusing to cooperate now that Democrats have complete control of the legislative and executive parts of the government. If the economy slows and the new stimulus is not provided, one Morgan Stanley analyst predicts a 20% decline in stock prices. Can we expect a bailout in China's situation? China's state-backed funds, or so-called national team, established to fight the 2015 stock market collapse, failed to halt the sell-off. The Shanghai Composite fell more than 30% 5 months after they formally began purchasing in July of that year. The authorities are generally tight-lipped about market interventions, but policy tweaking and warnings against undue leverage in sectors are common. So, what should you do with everything that's happening? I bet you think you should sell, right? Hold up, not so quickly. As Bloomberg's Brian Chapata pointed out, greater concern about dropping stock prices and a possible market correction may encourage individuals to participate in more trading activity, which may benefit the bottom lines of the same investment banks who say a bear market is imminent. Also, the current turbulence seems odd, since stocks have consistently gained at the start of 2021. That is to say, the present decline seems harsher since equities had previously done so well. When it comes to investment, though, the odd downturn is all part of the package. In general, it's a fantastic bargain for long-term investors. While there was an avalanche of big news events between 2019 and 2021, the Chinese-American trade war, a worldwide epidemic, and enormous stimulus bills, stocks fared surprisingly well. And S&P 500 increased by 29% in 2019, 16% in 2020, and 18% so far in 2021. It was Evergrande in March. Now it's Evergrande, and who knows what new catastrophe may hit in the months ahead. Just know that smart investors perform well by absorbing and understanding the news rather than trading on it. That's it for this video. Thank you for watching. If you like this video, we got a lot more in store for you. Don't forget to give us a like, subscribe to our channel, and click the notification bell so you'll be updated in our future videos. I'll see you next time.